Hi, welcome to Market Update for April 7th. Well, Unemployment Friday, folks, and usually that is the most important thing we talk about on Unemployment Day, but as it turns out, that's not the most important thing. What's really captured the market's attention is headline risk, and this time it's not domestic political headline risk, it's more of an international geopolitical risk that we're talking about. The missiles that were launched last night into Syria start at probably a bit of an effect in the market whereby we start to see volatility creeping back in. Now, what do I mean by that? Well, remember, we had been focusing on what was a domestic political risk, and that is the pro-growth Trump agenda actually getting through Congress. Now what we have to start doing is focusing on geopolitical risk. Now, why is that important to traders and investors? Well, because a lot of the money that's going to be committed over the course of the next few months that's going into the markets presently comes in from overseas. So if that money starts to be stifled, or more importantly, if we start to see an obstacle because of any kind of wartime activity that takes place in the Middle East, or a prolonged type of interaction between ourselves and some of the other superpowers, all of that cash will probably stay on the sidelines, or more importantly, go into fixed income, which, by the way, we see doing over the course of the last couple of weeks. Remember, we've seen a huge move in the 10-year here in the United States from the 260 level down underneath the 235 level. All of that tells us is that there is a flight to quality. So going into this next couple of weeks, let's pay attention to a couple of things. One, of course, is the fact that these risks are going to play havoc with the pricing of the market. And two, the unemployment number, what we saw today, which, by the way, by all accounts could be considered disappointing when you look at non-farm payrolls, which were under 100,000 plus revisions down from the last couple of months. But the headline number at 4.5% pretty much locks in a rate hike for the Fed in June. So let's see over the course of the next couple of weeks and next couple of months for that matter, whether there's anything between now and then that would keep the Fed from making that move. That is what the market is really going to price itself on, and all of the risks that we just talked about. This is Jack Barugian from the CME Group in Chicago.